people can develop a god complex because the commodity price goes in in the right direction.
Pretty
for
human
their
thing to do.
project. Yeah, and it is seductive ultimately.
Righto, Money Miners. Bloody JD's back in the house. Good to have you back, mate.
Good to be back, mate.
Bloody, there was questions of what you were doing in a hotel room over in Melbourne, but it was his house. We opened up the door yesterday to give it a bit of sex it up a bit.
It was a broom closet, wasn't it? Good to have you back, mate.
Mate, good. Great interview with Vass from Collins Street Value Management. That was bloody sensational. Love the way he thinks.
Absolutely. Took a heap out of that one myself.
If it's in the news, we're not interested.
Yeah, a deep value guy, mate. Real deep value guy.
Deep fucking value. Mate, JD, we've got another bloody spectacular one today. A repeat offender.
Exactly, we do. We've got Emmanuel Datt from Datt Capital to be interviewed today. So I thought this was a pretty good chat. And obviously the money miners that have been with us for a little while will know he's familiar. We've had him on a couple of times in one sort of long form interview in the past. So the way I thought we would go about it with Emmanuel this time around would be to pick about some of the articles he's written. So he started getting pretty active on Substack and
everything.
Twitter.
Yeah, he's bloody all everywhere.
Yeah, absolutely. So the thing that stood out to me first and foremost was the adages to live by as a resource investor, and it feels like it's just whacked us all in the face in the last month or two with everything that's gone on. So I thought breaking down the sort of 4 rules that he's learnt from his experience as a investor in the resource space would be a good way to go. And then we sort of dove in deeper on the likes of nickel, lithium, iron ore, coal, as well as some other ideas that he's spoken about, like the adoption of electric vehicles and all these sorts of things going on in markets right now.
I've been really, I've liked reading his writing on the coal stocks, mate. I found that really valuable, and not many people are putting writing out about coal stocks. So I'm keen to listen to what you have to say on that front. And I mean, he's been pretty bloody pertinent talking about the WA nickel scene as well. So keen to hear your conversation on that front.
Absolutely, he sure has been. So it'd be a good one to share.
There you go. Is he invested in, if he's in coal over east or anything, is he invested in any of the tunnelling or anything over there? No.
I don't know where you're going to go with this, Matthew.
Well, because if he was, he'd know that the SMEC VSDs are in the tunnels over there.
Are they?
Yeah, mate. Just had it dropped at my door there.
What mines are they in over there?
Oh, all the cross city tunnels and all that.
Oh, cross city tunnels. What is a cross city tunnel?
Just a big bloody. How Perth's got one tunnel, Graham
Farmer. Yeah.
Sydney's just got a absolute metric fuck ton of them under the.
When we went to the conference,
really, they're bloody everywhere.
We went through like 5 different tunnels on the way to the Airbnb.
So they've just dug under the ground.
They've got their variable. What is it called?
Variable speed drive, mate,
and that's in the tunnels.
That is in the tunnels. That is making those tunnels safe and ventilated.
Jeez, it's not just mines.
And saving power. Mate, can they do anything else? Don't niche bloody SMEC just to mining. Mate, tunnelling as well.
That's pretty cool. That's pretty cool.
That is a boring company that I would be very supportive of because they are looking after the shareholders there.
Did you do that?
Are you talking about SMEC or boring? I thought you were saying SMEC was boring.
No, the tunnelling businesses, mate.
Yeah. Mate,
they're looking after their shareholders.
Oh, mate, bloody loving it. They are expanding.
It pays for itself as well.
Mate, they were originally they West Gold, they had gold fields. So this is like, you don't have to have gold in your name to get a VSD, an event on demand system. I can tell you that much.
You just have to want to save money.
It is proven, it's ready to go, and that's why we are vetting it.
So JD's such a bloody a penny pincher. I reckon he'd be buying VSDs for his house.
Mate, you should get a VSD on a split system in your house.
I was just thinking we can have one for when you're vaping in the office and just get some fresh air in here.
Well, no, you could have, here's where it'll tie in. So with the VSD, so that's the variable speed thing that controls the secondary fan, and then you integrate event on demand system with it. So how it works underground, boys. So essentially each, like a truck, will require a certain amount of flow because it's a bigger, based on the kilowatts, they need a certain amount of airflow to get rid of all the gas. So then a bogger will be less, a jumbo will be even less than that. So each machine has a tag on it. So when it goes into a level, the vent on demand system detects it and says, right, there's a truck in there. We need X amount of kilowatts coming out of the fan to put that much air in. When it comes back out, it'll turn the fan back down to like 3 kilowatts, so it's not using any power. A bogger will go in. Say if there's a bogger and a truck goes in, it'll ramp it up because it knows they're both in there. When they come out, it dials it down. If just a jumbo goes in, it'll ramp it up a tiny bit, so it's not using much power, but the jumbo doesn't rip the vent bag down. How this is relevant to the Money of Mine studio, we could set up a vent on demand system. We'll put a tag on me, so when I walk in, it'll know I'm going to be vaping.
All automated.
All automated. Don't incorporate it into Alexa, crank the fan up, and then as soon as I walk out, turn it down. Even though we're paying like fixed rent here, we care about our landlord.
We're doing the right thing.
Yeah.
SMEC, if you can, if you do have time other than supplying VSDs and vent on demands through the mining and tunnelling industry, boys, we would like some residential applications.
That's
commercial office applications. I think it'd be, mate, we'd be getting along great.
I
Love it, Smack.
That's awesome, mate.
Good work, Smack. Now, did old Daddy would have, we know he's not shy of a bit of love for the old niobium and West Arunta area. You had a bit of a yarn about it.
That is the case, yeah. Late on in the interview, we touched on his substantial holding.
And because they're in that, like that, it's the drill out phase, heading towards a resource. Like we're all waiting for it. I want to know if Anytime Exploration are out there because, you know, that'd be a tick in my books, boys. If Anytime and Seamus, mate, Seamus, we've said he's been Darwin, Halls Creek, Europe,
Chile, Argentina.
If he's been everywhere, so he's definitely been to the West Arunta.
So if you grew up in Halls Creek,
is that pretty close to West Arunta?
well, nothing's close to West Arunta, but it's not. It's like
It's just like 500 k's
It's
to
close.
south.
Seamus is acclimatised to the West Arunta region, mate. You could drop him and the Anytime in there for, mate, anything. They would love nothing more than cutting up some WA1 core. They'd love nothing more than bloody doing a bit of soil sampling for some extra targets. Mate, they could chuck some people out there, the all-terrain vehicles, and after all that, they can do the mineral resource estimate for WA1.
And Emmanuel would feel that much more relaxed knowing Anytime is on the case.
Wouldn't he just, as a major shareholder, I feel for him and I want to put him at ease.
Yeah.
I don't want that capital, the Datt capital, to be at any risk, and that's why you need Anytime Exploration there. Seamus Murphy.
Give him a
Seamus
call.
Murphy, local experience in the West Arunta.
true dat, Matty.
True Datt. That is the best column name. Mate, Anytime Exploration, anything you need, exploration, anytime, anywhere, anything, bloody legends. And don't forget, they do mineral resource estimates and geo consulting. Mate, unbelievable. And, mate, there's more news coming.
Watch this
Hang
space.
on to your seats. Right, let's get into the yarn with Manny Datt. He's all dat.
Alrighty, Money Miners. We've got Emmanuel Datt, almost a recurring guest now. You've been on a couple times. Thanks for making the time to come on Money of Mine, Emmanuel.
Yeah, no worries. Thanks for having us, JD.
So I'm pretty pumped to get into a whole bunch of different things. So obviously, markets have been pretty wild the last month or so, in particular commodities. And you've been getting a bit more active on Substack, writing on Twitter and everything. So I want to start by just asking your thoughts of the macro. I saw you put up a tweet yesterday sort of summarizing what's going on out there. So we've got interest rates being held at 4.35, inflation coming down, I think at 4.1, like net migration coming in the country of 500,000 people.
Yeah.
So I'm keen just to break down your thoughts to start with on the Aussie economy in a broader sense.
Yeah, sure. I think it's a really interesting set of circumstances that we find ourselves in. I think the most notable sort of takeaway out of that is that out of the RBA interest rate decision is that the RBA seemed to be sort of on the path to normalizing real interest rates. So for those that don't know, the RBA cash rate less the inflation rate gives you the real interest rate effectively. And the last 4 or so years now, real rates have been well and truly negative, and now it seems the government are sort of trying to normalize, I guess, the real interest rate
Yeah, and are you in the camp that inflation is sort of on the way down, or do you have the same outlook as some other investors that we're going to have a sort of stickier decade or so to come? Obviously, that's casting a long wide eye.
Yeah. Well, it's a interesting question. I think that inflation is something that's always going to be present. I think that it's likely that we've seen the peak of inflation for now. I would say things can always change, of course, but I think that the fears are well and truly gone now, and I think that we are sort of seeing that flow through. I think, I noted the ASX sort of trade numbers, and they were actually up 7% PCP, and I think that's a really interesting observation, I guess, because it does show that people out there, they're not worried about necessarily consuming or investing in housing or their everyday expenses, but I always think that we've hit the bottom of the cycle when it comes to market participation. As we know, during COVID and the lockdowns and all that sort of thing, market participation amongst retail investors grew exponentially,
skyrocketed,
and then sort of tapered down as things normalized. And I think that's a really interesting dynamic, because it actually means that, well, people aren't worried too much about their immediate needs in terms of the next couple of months ahead, let's say, but they're actually able to invest because they have the comfort that they can put money to work over, let's call it a few month time horizon and beyond.
And taking a bit of a wider view, looking at the States over in America, obviously it's a big driver for economies all around the world, what they sort of do. Do you have a sort of similar view of their economy and the decisions they're going to make? You sort of get the impression that they might perhaps pull back and start cutting rates a bit sooner than we will here. That's the sort of trick you hear anyway. You got a thought?
Oh, well, to be honest, I don't know the US economy as intimately as the Australian economy. I know that obviously they're a big influence on us, but so are the Chinese, if not more so, even more relevant to the Australian economy. It's very hard for me to sort of provide a really strong opinion on the US economy. But I think that most notably for our resources industry locally, the IRA Act, irrespective, I don't think it's going to disappear anytime soon, and that's of course been a big stimulant to our local resources industry.
Absolutely.
Yeah.
So getting into resources, then you wrote a Substack article in January sometime, and I'd recommend any of the money miners interested to go and read it. It's called the Adages to Live By as a Resource Investor, and I'm interested in breaking these down. So I'm just going to read out the heading of each of the 4 adages you go through.
Sure.
And then I'm keen to hear the thinking behind them, whether they've come about from tough lessons learnt perhaps, or how they came about. So the first one is the pursuit of locally prevalent ideologies or ideas are of no consequence to global fungible markets. So the elephant in the room there is metal price bifurcation. So how did this one kind of come about in your mind?
Well, I think over the past 6 months or so, I'd been reading and observing the media that there was this notion that the world was effectively willing to pay 2 different prices for effectively what is the same commodity. So I think that in itself is a very difficult concept for me to grasp, because, coming from a commercial background, if something's not going to provide me extra utility or use, why would I pay extra for it? I think that's just very much part of human nature, and what was being suggested goes against that human nature.
Do you see any sort of future with it? We could be talking a long time down the road, or are you of the other sort of camp that in the short to medium term, it's just not something that we're going to see in metals markets?
I can't see it happening personally, and why I say that is that it all comes down to the free market ultimately. Unless there are particular, government stipulations that require and force the issue, that could be the only way that I can see it happening over time. But otherwise, market forces are always, first and foremost. I mean, over the long term, that's what happens.
Yeah. So the view you've sort of expressed here isn't one that was, as widely held perhaps a year ago. We saw it with BHB, to name just one of the many companies that seem to buy into this thesis that there's going to be various prices for the same thing. How do you kind of think the people that made those decisions are looking back, or going forward from here? Do you think they're feeling a bit stupid, or do you think they're right to keep fighting for the outcome?
Well, when you get punched, you got to get up off the ground and move on ultimately. Yeah, and it's always very easy to look back at mistakes in retrospect. So perhaps at that time, the thesis did appear sound. I'm obviously not privy to all the information that people on the other side may have had, or what they were anticipating. But I think that ultimately, everyone does make mistakes. Some bigger than others, of course. But I think that it's you invest as an investor today for an expectation of future return. And those on the other side obviously did, and it didn't pay off, but you move on to fight another day.
Yeah, absolutely. It's interesting. We'd spoken with people 8 to 10 months ago, and there was this notion that it was already upon us, in terms of payabilities that companies are actually getting, and that kind of speaks to what you said. It's the people on the other side, so we don't have as much clarity on those sorts of things. But if that were the case, it seems to have ended quite abruptly in the last half year. The next adage you wrote was that marginal assets get hit the hardest when sentiment turns, and this feels glaringly obvious in hindsight when you look back. And it kind of reminds me of one of Warren Buffett's quotes that you only notice who's swimming naked once the tide goes out. A classic, but it seems stupid because it doesn't have to be that way. You can see the costs of all companies, be it could be different if it's a PFS, DFS versus if they're actually producing, but you should have a good grasp as an investor what the costs are going to be. Yeah. Why do you think this mistake keeps getting made by investors?
I think it's I think that it's a mistake not only made by investors but by companies as well. And I think that ultimately it all comes down to controlling your downside. Ultimately. An example I can probably give of that is that, there are plenty of gold projects out there, for instance. If you're sort of trying to start producing gold, typically in the project financing arrangements, you generally would have a portion of production hedged just to protect the financier. Yeah. And of course, the range of production hedging is, also, I mean, to a degree, it's driven at the minimum amount is driven by the financier, but then anything above that is driven by the company itself. Yeah. You see that consistently, irrespective of the claimed cost base of the project or company. So what I'm saying is that financiers are generally are smart money as well, right? And they know ultimately they're lending money for a fixed return, so they need to protect their downside. Yeah. And I think that with companies, they don't necessarily always think about protecting that downside first. And because at the equity level, your returns are theoretically unlimited. Yeah. So I think there's that sort of element of human nature in terms of wanting to go for the big score. Definitely. Of a marginal asset is obviously an asset that would have a higher cost base, and so have a lot of leverage to upside.
Absolutely, that's kind of my thinking behind it. Is that it's probably a habit that never dies, right? Because the high cost assets and companies have such torque to the commodity price. So when things turn, they can make once in every 10 or 20 years outrageous profits. So seems like that sort of risk return is always going to attract those sorts of equity holders, right?
Absolutely.
Yeah.
Yeah.
The next point that you wrote, the next adage, was that sunk capital has little value until the cycle turns. And you gave a great example of this. Champion Iron with the great ticker CIA.
Yeah.
And they've got a high quality, high grade iron ore asset up in Canada. I think just to start with, for those unfamiliar, can you just sort of run through the story there? And I'm interested to hear if this is one that you lived out in real time or learnt about in retrospect.
Yeah, sure. So this was one that I learnt about in retrospect, and I actually I saw the story evolve when the project was first taken over and listed in Australia, and then ramped up to production. So to give a bit of context, so this is iron or magnetite project. There are some points of difference around whether it's magnetite or hematite, but for me, all intents and purposes, for me, it's a magnetite project.
Yeah.
Effectively, past owners of this asset sank huge amounts of capital, somewhere in the region of $4 to $5 billion in infrastructure costs before abandoning the project. The current CEO, basically bought these assets for about $50 million, so 1% of the costs that had actually been sort of put into the project.
Yeah,
and that was actually the foundation, I guess, and it was a huge head start for equity investors that were able to piggyback off that past expenditure.
And it's in the doldrums, right? 2016-ish, give or take, when iron ore and resources across the whole complex are pretty hated.
That's right.
So
yeah,
picking the cycle pretty well there.
Yeah, exactly right. But, it's a very unique situation, I would say. I would probably say, if you've got and I should also mention it's a substantial asset in terms of size. So, sunk costs, if they're expended on a small asset that's perhaps more marginal, you'd have a much higher probability of, that's just dead money basically.
Yeah,
when it's quite a different situation.
And then on the flip side, they can reap the economies of scale coming out. So it's just a beautiful double whammy if you can pull it off. Another interesting facet about these types of transactions where companies pick up the essentially fallen previous companies is that you don't really appreciate the value at the time. So you still could have bought Champion Iron post this acquisition for a long period whilst the cycle hasn't yet turned. So it does present investors an opportunity, right?
Yeah, absolutely.
The last of the four adages is that bias can affect even the most highly regarded and adroit personalities. And I got to say, this is probably my favorite of the four. It really speaks to the sorts of characters you get leading companies and the internal conflicts as an investor, right? So it's quite double-edged in that nature, and I'm keen to hear how you go about sort of recognizing it. Firstly, within yourself, the biases that you might be under during a bull market, and then on the flip side of that, the biases that can sort of take control of the manager or the entrepreneur of a company.
Yeah, sure. I think that people can develop a God complex because the commodity price goes in the right direction.
Pretty
for
human
their
thing
project.
to do.
Yeah. And, it is seductive ultimately,
Yeah.
but I think you've always got to be, identify the risks in any sort of endeavor that you're undertaking.
Yeah.
And, I think that the world can always change tomorrow, most importantly. You can't sort of go into anything assuming that your present set of circumstances will persist, over a reasonable time frame.
And you invest across various sectors as well, right? So you're not just resource focused like we are on Money of Mine. I'm interested to hear if this is more prevalent. Like there's a real concept out there that is tied strongly with people in Silicon Valley.
Yeah.
But as well, the the nature of the resource business, needing to raise capital, needing to front up to investors all the time and hold your hand out, lends itself pretty well to people that are good at that, people that are good at promoting and all those sorts of tricks and attributes, right?
Yeah. And I think that, to some degree, I think resources companies are unfairly tarnished across the board for being, big capital sink. I'd probably say biotechnology is probably even more of a sink, but doesn't have that same sort of perception, even though it's in my opinion it's a lot worse. But I think that ultimately there are a lot of businesses out there that are making a go of things on listed markets, and that does require capital and staying power from investors. I think people who are good at selling obviously advantaged in public markets where you're trying to raise capital and from stakeholders and various intermediaries, etc. I think that's very much part of human nature once again.
Yeah, the storytelling nature it's a key attribute in both a fraud, but in a very successfare leader of a company as well.
Yeah, so absolutely.
Hard to distinguish.
And you've probably experienced it yourself, talking to charismatic CEOs. There are very few CEOs that I've met that I don't find charismatic personally.
Yeah, and we touched on this last time. It really plays into your investment style and how you want to go about having face-to-face interaction with companies, whether you want to meet management. I think it's worth reminding the money miners just of your sort of opinion on and how you go about that sort of engagement.
Yeah, sure. So basically, in our own methodology, we don't typically meet the management before the investment decision has been made. And that's effectively just to eliminate, the bias. As I mentioned, a lot of CEOs can be very charismatic, but then you tend to develop a bias towards someone who's likable.
Yeah.
And that can sort of skew your decision making, which ideally you want to be make impartial, solid decisions based on fact, not because you like, someone.
Yeah, that's a fascinating way you go about it here.
Yeah.
I'm super interested to jump into the world of commodities now. So one of the commodities you've written most about is nickel. So I think it's a sort of logical place to start. And the first question I have is, obviously all the changes that we are experiencing are predominantly coming from what's happened in Indonesia, tied in with the Chinese investment, as well as the sort of breakthroughs that Tsingshan and other operators have had on a tech level. So I'm interested to hear your thoughts on whether, the West should have been a bit more cognizant and a bit more wary in actually seeing what was happening over there and, relaying that information into their decision making.
Yeah, I think so. I think the ultimate error, in my opinion, was that, going back a couple of years, I believe Tsingshan at that time, went out to the world and said, we've developed a way to convert laterite products derived from nickel laterite deposits into nickel matte. So effectively cross that bridge to convert,
class 2 into 1.
Yeah, class 2 into 1 effectively. And at that time, everyone thought, well, this doesn't sound right. It's never been done before. And given it was from the Chinese, I feel that there was an extra element of doubt around that claim.
Yeah.
So, and in retrospect, I think, there must be a hell of a lot of investors out there feeling and looking pretty silly at this stage of the game. I mean, given what's happened over the consequent 2 years. And
sorry to butt in there, the change, I just want to pick a thread that you've written about from a sort of, more or less integrated supply chain into a much more integrated supply chain with the company sort of running the rule from the upstream to the downstream.
Yeah.
Is a real game changer that you don't see, you see it in some commodities, but there's not an awful lot of commodities you see that in, right?
Yeah, exactly. It's quite a unique situation. Typically, downstream consumers of the product typically want nothing to do with upstream.
Yeah.
However, it's a situation that has been reversed, but I think it is, it's not unique in terms of a Chinese way of doing business, in the sense of a strong emphasis on vertical integration and security of supply. We've seen that in other parts of the industry, like the lithium industry, where you see Ganfeng in particular try and vertically integrate as much as possible. So from my perception, I think the same is happening in the nickel industry with Tsingshan.
And is the outcome that consumers are better off? Is that one way, a positive sort of lens to view it in?
Yeah, well, I think so, because ultimately it's an input cost that they have control over, and if they can keep nickel cheap for their own operations, then I think that only has benefit to the end consumer of the products they're making.
And on the flip side of that, you have Tsingshan, the giant in the industry that has a much firmer grip on the whole chain, obviously now. So do you see a heightened risk that they could potentially constrain supply at some point in the interest of improving their margins?
In terms of, are you talking about the upstream commodity?
Just given that they have a firmer sort of grasp across the whole board, they could, say, limit capex in the upstream and sort of at the other end put out less supply in the hope of increasing the commodity price once they've killed off the competition.
I don't think that's really the end game here. I think that it works to their benefit if they keep commodity the nickel price subdued, I guess is the best way, because ultimately all nickel projects have an incentive price, right? Yeah. So ultimately, the best case is that they keep nickel prices low enough below that particular incentive price for
just $1 behind.
Yeah, for a good part of the cost curve out there.
Yeah,
that's ideal for them.
Absolutely. So bringing it back home to our Australian nickel industry, which is really on the rocks at the moment. There was a meeting a couple of weeks ago between Madeleine King, the resource minister, and various representatives from any company with a nickel interest, as well as later a lithium one as well. Yeah. I'm interested to hear your thoughts, and we're straying into probably politics here, but how you should view Australia's response in terms of royalty reliefs, tax reliefs, any of these sorts of things, given that the messaging has been that there would likely be some sort of relief. At least that's what the companies are lobbying for.
Yeah, well, I think it's an interesting situation, and I think that in many ways, I think it's almost fighting a losing battle, irrespective. I mean, if the government do provide the range of initiatives that have been talked about, I think that's effectively dead money from, it's basically subsidizing and provide, or at least trying to support the operations of these various upstream producers. But I think it's a waste of capital in a nutshell, given it's a global market that these companies are participating in. Yeah. So it's basically money going to, the upstream Australian nickel producers themselves for what benefit? That's ultimately what, I ask my question. Yeah. I mean, in terms of the mines, sure, they'll be operational, but, I know that the mining labor availability is still pretty tight out there. Also, I hear. So yeah, I just don't really see, a compelling reason why the government should interfere in market environment at the moment.
Yeah, understood. There's a couple tough decisions you'd imagine to be made, in particular, given that BHP has the decision to, reinvest a significant amount of money in the Kalgoorlie area. Yeah. Coming up in the next couple years. It'll be a fascinating one to follow. The last question I've got on nickel is what happened in 2022. In March of 2022, you had a disaster really from the LME's point of view, where they ended up reversing a number of transactions when the lithium, the nickel price went from $30,000 US per ton to $100,000 in an extremely short amount of period. Are there any ramifications, or do you have any other thoughts about how that all sort of transpired and the repercussions of it?
Yeah. Well, it's, just an incredible situation, really.
Yeah.
I remember sort of being online late at night and watching it happen in real time, and people just like losing their minds, like what's going on? I think there were question marks at the time. Has some like big mine suddenly, shut down
Yeah.
for whatever reason, or has there been a natural disaster? But ultimately, it was just, I think the post-mortem of the situation was that it appeared that it was really just, arm wrestling between two market participants, and one had more capital than the other, essentially. Yeah.
Seems as one had a bit more political clout as well in hindsight.
Yeah, absolutely.
A bit suspect.
The one on the wrong end had more political clout.
Absolutely.
Yeah.
The next commodity I want to talk about is lithium. So all the rage for the last 3 years, it is just wild to take a step back and think that just 3 years ago, roughly, there were subsidy reliefs and those sorts of things that we're now talking about for nickel in the lithium industry, and just how quickly that price 10x'd and just how quickly that price fell by 90% on the reverse is a sort of lesson in how quick markets can move. It's very fascinating. And I'm interested just to talk through a number of the events that have happened at some of the major companies in the past month or so. So first up, one of the biggest bits of news is that Liontown had their bank financing pulled by their syndicate of 8 from memory, different banks. They'd put up $760 million and it looked like it was signed, sealed and delivered. And then it's just been pulled. So do you have thoughts on whether the banks should be more on the hook about how that went out, or they're completely in the right? What's your opinion on that?
I think that banks will always lend money if they're comfortable and confident around the situation. Liontown are doing something quite unique in terms of their mine itself being an underground lithium mine, which is unconventional, in Australia. I think that ultimately anything novel is going to be subject to ramp-up risk, no matter which way you look at it. And given the massive downside that we saw sort of in lithium spot prices, I think that was warranted for the banks to walk away. I think ultimately financiers, going back to that fact again, financiers need to control and protect their downside as much as possible.
Yep.
But then, even when you're providing debt to a particular project, you want enough equity to sort of be in that first loss position and act as a buffer. And obviously, the banks didn't have confidence around that situation.
And do you think that Liontown will still secure funding, and in what sort of shape do you think that might take?
Yeah, well, it's really hard to say. I think that, the most obvious for me is that, they should just raise equity again. But then again, I think an equity raise, it'll be tough to, sort of pursue, given that, from memory, the CapEx estimate has sort of shifted 2 or 3 times during the sort of progression of the project. But on the positive side, I think that they're almost, they're about 70% through the build. So, that sort of does decrease the risk of, substantial cost blowouts from here on. But, to attract the risk capital, it's going to have to look attractive for them.
Yeah, it'd be a bitter pill to swallow with seeing in the rearview mirror a capital raise that was done at a 40% discount. From memory. So.
Yeah. But ultimately, they're subject to the same market forces as anyone else. So,
Moving to a couple of different mines now. On the MinRes call, the quarterly call in late January, Ellison and the team there were eager to stress that Wodgina, Mount Marion and Bald Hill were all profitable at these lithium prices. lithium prices were circa US $850, $900 a ton.
Mm-hmm.
How did you take that statement at face value?
I would probably say that it probably depends on their offtake arrangements. Like as we've seen with Greenbushes, which has just had its offtake rejigged. It really depends on the frequency of repricing in the offtakes itself. So I'm not across the the details of that, or I'm not sure if they publicly disclose that. So it could be true at that point in time, whether it could be based off pricing 3 months ago when prices were significantly stronger, but the devil's in the detail.
The next quarterly, I guess, will be there, and the financials coming out in a couple of weeks. Will be super interesting.
But and just going back to Mineral Resources, these 3 assets, these I would probably say they're more marginal type assets, and you can really use them almost as a bellwether when you see sort of Mount Marion and Bald Hill being put and Wagina even being put on care and maintenance. That's kind of when you know that, well, we must be getting close to the bottom. As we saw, in the last lithium cycle, not too long, a few years back now.
Yeah, and the price really starts to eat into that cost curve.
Yeah, exactly.
One of the next companies I want to talk about is Greenbushes. So
Sure.
we sort of touched on it there, obviously, but not just the pricing mechanism being rejigged, but you've also got production being reduced. And that's just fascinating to see for a company, for an asset that sits as low as that does on the cost curve. When you sort of first read that announcement, what were your thoughts?
I was I wasn't surprised, but I was a little shocked that they were actually cutting production. For those that don't know, Greenbushes is probably the world's the hard rock mine that sits lowest on the cost curve. So I would have probably expected production costs from assets that were sort of higher up the cost curve. So I think it was an interesting situation, but it also demonstrated to me that the joint venture there that owns Greenbushes mine is pretty complicated, and you've got to really be conscious about all the risk factors.
It really underlined to us the intricacies of not being the controlling partner within a joint venture arrangement.
Yeah, exactly. Especially when your partner's one of the off-takers as well.
That sort of leads in well to my last question on lithium. Which is sort of in and around the downstream within Australia. So we mentioned the parties there, and there's numerous others looking to go downstream inside Australia at a cost that is significantly higher. And not just that the cost is significantly higher, but the execution just hasn't been there. And we saw in the IGO announcement that, from memory, they produced 600 tonnes from a plant that's meant to have 24,000 tonnes per annum. Granted, that was the quarter, but still, the numbers aren't great. Do you think these are short-term pains for downstream in Australia, or do you think this is a really bad sign of what the long-term could look like?
I think it's a bad sign of what the long-term holds. I think Australia, it's not a cheap place to manufacture. Just look at our lack of a local car manufacturing industry as an example. And for me, it never really made sense, given that the product that's output, lithium hydroxide, has a fairly short shelf life. So, it really made not much sense to me that, well, why are you trying to manufacture lithium hydroxide, shipping it overseas, manufacturing a battery overseas that will eventually be put in a car? Just didn't really make sense to me. But then there are other sort of projects that are trying to sort of make intermediary products.
Pilbara Minerals.
Correct. Yeah, that's right.
Midstream sort of.
Yeah, midstream sort of products. And to me, that makes a lot more sense than trying to go, full down to downstream.
Yeah, it'll be
product.
Very fascinating to see how things play out up at Pilgangoora there.
Yeah.
The next commodity you've written quite a bit about is coal, and you posted a photo of the book Boganer about Nathan Tinkler
Yeah.
and really focusing on that period 10 or so years ago
Yeah.
in the Australian coal industry. So first of all, what are the takeaways from, looking back at a pretty bullish time in commodity markets?
Yeah, well, it was a really interesting read. Picked it up on from a random op shop on my holiday, and it was great read. I think I finished it in just a couple of days. It was riveting stuff. But I think it really, it really hammered home that every commodity has big bull and bear cycles, and I think you've got to be really conscious about what you invest in. In his particular case, he invested in assets that were probably viewed as being higher up the cost curve, so more marginal assets. But he was able to successfully ride, the commodity price bull movement at two separate times and exit before it's sort of been reverted back to normal.
Yeah. And coal has definitely changed since that book was written in terms of the perception it has in the market.
Yeah.
And I'm interested to unpack how you view that change in access to debt markets and the flow-on effects of the equities, right?
Yep. Well, I think it's of a lot of benefit to equity holders. Ultimately, if you can purchase stocks at very cheap valuations with high shareholder returns, I think that the reluctance of debt holders to get it to finance these sort of projects ends up working beneficially for equity holders. And just going back to that time 10 years ago when it wasn't unusual for big Australian banks to finance new coal projects. But that sort of capital is just not available anymore, and the sort of permitting and timeline and the whole life cycle around that permitting process, it's well beyond the investment time horizon of most public company
definitely.
investors.
You also wrote about various attributes that could lead to a re-rate in the coal sector.
Yeah.
I want to hear how this sort of, butts up head to head with the lack of institutional capital that we see at the moment in the space, and whether there's really a means for a re-rate or whether the buybacks and these sorts of forms of capital returned are, the here and now and into the future.
Yeah, sure. So I think that there hasn't been, with the lack of debt finance in the space, that's obviously constrained the new supply along with the permitting issues. I think ultimately to re-rate these assets back to their historical multiples, first and foremost, you need certainty, right, around the commodity prices. We've seen, over the past few years, a huge, we saw like a huge spike in thermal coal prices up to 400 USD a ton, when the historical sort of, if you rewind back 10 years, it was probably more like $50 a ton. Yeah. To give you an example. Now I think we've kind of bottomed. I think we're about $120 a ton or so for nuke spec coal, and it very much looks like a solid base, I would say, given that demand rises, marginal increments each year, but the supply is sort of the increase in new supply is struggling to keep up. So over enough years, that does add up to a substantial differential.
Yeah.
But I think just having that solid foundation, that and certainty that higher coal prices are here to stay versus the typical sub $100 a ton coal prices we've had as a historical norm. So it's just
balancing them,
balancing in it, and understanding the change in the
Yeah,
future
we'll
cost-
have to
cost
see
structure.
how that plays out.
Mm.
Iron ore is another commodity I wanted to touch on, just
Sure.
given, I guess we spoke about its significance at the beginning of the show, talking about
Mhm.
China, because it's really
Yeah.
the elephant in the room there is iron ore.
Mm.
And the price has just been phenomenally resilient for a long time now, far longer than most analysts
Yeah.
expected. How do you sort of think about this resilience in the iron ore price,
Mm.
bearing in mind what's happened with the property sector there, Evergrande, and the sort of slowing, as well as the lack of investment across the board?
Yeah. I think it's an interesting situation. I think that Evergrande, well, obviously a developer, and I don't think that developers are necessarily what I would consider to be the drivers of steel demand. I think infrastructure use is, and projects consume far more steel. And that's looking at China in isolation, mind you. So I think there's, another big economy, India, in Asia, that is going, just undergoing massive change and massive investment in infrastructure. I was actually there. Here's a funny story that you'll probably like. I was actually back in India, not this last Christmas, but the Christmas before.
Yep.
Driving through rural India, middle of nowhere in central India. And the most common item on billboards in the street was different brands of steel reinforcement. If you can believe that, not consumer goods like cosmetics or shampoo or soap or whatever you'd think. 90% of billboards were of different types of steel reinforcement.
I can't imagine we'll ever get that in here in Australia.
Yeah. And, India's probably like at least 20 years behind in terms of China, in terms of infrastructure. So, so I think, in a nutshell, I think that the outlook is steady. I mean, sure, you'll get volatility depending on, what's happening around the world. But, I think there's always going to be sort of, for at least the next, 10 to 20 years, I would expect there still to, be a solid demand for steel.
Fascinating.
And iron ore
It's,
by proxy.
yeah, absolutely. It's a sort of investment thesis that sort of see more and more of, and some people are very much, in the camp, they're bullish it, but it'd be interesting to see if that plays out like a sort of China 2.0.
Yeah.
So I want to move into a couple other posts, tweets, random things you've made comments on. And the first one that I want to talk about is Tesla and EV adoption, the change in battery technology, all these sorts of things. So Tesla came out with earnings.
Yeah.
A couple of weeks ago, they were sort of speaking about how sales were very good, but the prices had come back and they needed interest rates to go their way and a few other things. And your sort of comments were that you couldn't see the increase in penetration across the world happening with EVs unless there was significant advancements in battery technology, specifically fast charging battery technology. So just, riffing on that, I'd like to hear what you think about battery technology, where it's going, how the EV market is looking, all these sorts of things.
Yeah, sure. So I think EV penetration in Australia is in the high single digits from memory.
I think we're pretty far down on the
Yeah.
against the West.
Yeah, absolutely. And I think a lot of that is obviously skewed to the main metros, Sydney and Melbourne.
Yeah.
I think I would probably categorize these sort of EV users as early adopters. The first wave of option, then follow-on adopters. However, to really hit critical scale in the mainstream, you probably need at least 25 to 30% adoption as a start, where you actually see, commonplace, fast chargers as commonplace as a petrol station in metropolitan areas. I think to really sort of fire off a third wave of adoption, if it comes, is the development of fast charging capabilities that are comparable with, going to a petrol station and filling up petrol in your car. So down to, that sub 10-minute range. I think that sort of battery technology is required to really drive adoption. I myself, I drive a petrol car because I don't want to think about, plugging my car at home. And I like the convenience and the range, most importantly. So I think charge time and range are the two sort of big things for me, as a consumer.
So comparing this with what we spoke about earlier in nickel, both Chinese dominated essentially the growth in battery technology and EV manufacturing out of China has been quite remarkable. And I think it's just interesting to sort of put them side by side and see, hang on, given where we were, say, 5 years back in nickel, the growth that we saw, how do you sort of compare the two? Do you think that's an interesting way to look at just how quick the adoption and the, you can see it in the product releases from the likes of cattle, the profits, all these sorts of metrics. Do you see a quite quick growth coming out of China, or do you think this is still quite a while away?
It's hard to say. I think a lot depends on the battery technologies. I know in China, I think LFP batteries are most prevalent, and they're so they don't obviously have nickel or cobalt as part of their battery chemistries from memory. And but you need to get to really push along. They're experimenting with a range of commodities. Niobium, of course, is my favorite.
We'll get into that
for obvious reasons. But I think that even thinking about the potential wider spread, adoption or market penetration of EVs has a number of really interesting knock-on effects. You can't fill, a multi-story car park full of EVs just because the weight, they're not engineered to handle the weight of electric vehicles, but then you need steel, right, to improve the buildings. And so I think that further market penetration of EVs actually will drive the next leg of infrastructure development and demand for those sort of materials.
Yeah, it'd be a very interesting one to watch and see how Australia compares against the rest of the world there. Yeah. Let's talk about some stocks now. So you've touched on niobium. It's no secret that you're a fan of WA1.
Yeah.
And I'll disclose, I think all three of Trav, Maddie and myself own shares. So you can take what I say with a pinch of salt. But I want to hear what you have to say about, firstly, metallurgy and how, that is the sort of elephant in the room. It's the sort of issue that gets most spoken about with this stock, and we're anticipating results in this half year sometime. It's been flagged. So how are you thinking about that?
Yeah, well, I think that from what the company's disclosed so far, I think that metallurgy is always a journey. I think that initial sort of test work that they've released does sort of demonstrate that, the potential that, they can recover metal to at least a minimum sort of standard. They haven't really put out a great deal of information out there, but when I look at niobium projects across the world, typically the recoveries range between about 30 to 60%. So CBMM at Araxa recover about 60% of their product. There's been lots of different academic and benchtop studies of various other sort of, processes that increase those recoveries. But, just broadly, the range, global range is 30 to 60%. I would probably say that, and I think that we're sort of expecting a bit more detail from mid-year onwards. It does take, some time to perform all these various tests, especially for a fairly niche commodity like niobium. It's not like you're trying to recover gold, for instance. You've got to be, there's only a certain number of laboratories that have the capability to, perform various metallurgical tests and recovery processes.
And
So,
and how about CBMM? You mentioned them there. How do you think about WA1's position in a global market where a participant has 80+% of the production, the supply at a great recovery and great world beating grades as well? How do you see their willingness to accommodate for WA1 in the global market?
I think there's a lot of willingness, to be honest. And why I say that is that when a company controls 80% of the global market, it really stunts the growth of demand from my perspective. It means that the users will be very limited to those that are essential rather than mainstream. And one example that I always bring up is Linus. And when they were started producing, they were the world's only ex-Chinese sort of form of producer of rare earths. And they were strongly supported by the Japanese and South Koreans and all the East Asian countries that wanted a source of ex-Chinese demand. But once they had that certainty that, there is ex-Chinese demand, that's when we actually saw demand escalate for rare earth commodities. So I'm expecting, over time, there'll be a similar situation. I believe CBMM don't have or are constrained from increasing their capacity due to the ownership structure. But also the ore body itself, from my understanding, has limitations around the ability to increase production. But yeah, it's a really interesting dynamic. And if there's, for example, if WA1 managed to get their project up to a commercial, shovel-ready status, I think that there's going to be a lot of demand for their product, given the current industry structure. But also on the demand side, you've got things like niobium battery technology that we touched on just before, providing that potential moonshot that will be well above sort of our base case, in terms of just further market penetration within the steel industry itself.
Another company rather that you've spoken about in the past is Adriatic. We spoke about it last time.
Yep.
About halfway through last year, and they've been on a pretty interesting part of the journey in that construction phase, and they've had first production pushed out a couple times. I'm not familiar whether you're still holding it. I tried to dig in, but interested to hear how you see their sort of position as they, make this tightrope walk to first production and really seeing capital start to come in the door once the mine is fully up and operational. Yeah.
Well, I think that Adriatic, they've had a very fast journey, I would say. I think it's been about 5 years since they made the discovery holes and now just sort of commencing production. The company did guide to they have had sort of issues with ground conditions as they last disclosed in their last announcement that sort of pushed back production somewhat.
Yeah.
I think that, I think the mine is one that's very interesting because it still appears to be growing. But, I think that the company really need to prove to the market now, over this year that they're capable of, sort of hitting nameplate capacity. And also, I think the terms around, the payabilities of their products that they'll be producing is, going to be interesting as well.
Definitely. It's one we're all sort of watching quite closely.
Yeah.
Global Lithium was one we touched on when we last spoke, and amongst a couple others, Metals X and Dreadnaught. And I'm just interested to hear in reflection how you're viewing these companies, given they were all former holdings in the portfolio.
Yeah. I think that ultimately, I'll talk about global. That's obviously a it's a marginal lithium development asset.
Mm-hmm.
So I think that will have pretty good leverage to, any upside in the spodumene or sustaining upside to the to the spot price. Assets there, and they are progressing it, and through the feasibility studies, etc., and de-risking the project further. So I think that's a pretty good probably swing asset, I would say, rather than being
Absolutely.
I probably couldn't call it commercially viable at these prices given how low the spot prices are at the moment, but definitely sort of one to watch. I think with Dreadnaught, I think that they're still sort of exploring for various commodities. I think that they have defined a good deposit there, right next to Hastings of rare earths, and I think the natural thing to do between Hastings and Dreadnaught is just to combine these two resources that are very close to each other, and it'll definitely sort of help the future prospects of either of them coming into production ultimately.
Yeah, I think a bit of consolidation is due, not just in rare earths, but across the board.
Yeah. And then with Metals X, I thought their last quarterly was quite good, actually. Probably outperformed our expectations. But I think that, one thing that's always at the back of my mind is that when are they going to stop investing in junior gold players? So I just,
something we're all wondering.
Yeah, exactly. I would probably say it's more prudent to, focus on rewarding your, shareholders that have hung in there for the long term, and that will provide a lot more value add than, investing in projects that are substandard, in my opinion.
I'd agree with you there. Any other commodities, thematics, companies that are really catching your eye at the moment that you want to chat about?
Look, I think that the gold space is one that has obviously, popped up in a massive way, with the Silver Lake and Red 5 merger or takeover, whichever way you want to look at it. So I think that's interesting. I mean, we've looked at all the gold players. A lot of the gold players are struggling to maintain production. And I certainly do expect a lot more consolidation amongst, the ASX listed cohort.
You're talking specifically about the producers here, or do you think across the developer and explorer?
Yeah. Well, I think it may extend down to developers as well. I think any sort of company that has good Western Australian-based assets and that have, a decent sort of resource, let's call it, 400,000 ounces up, I think that, there's strong potential that these will be sort of consolidated in time, presuming they're close enough to a mill, that is. That's just sort of one sort of observation,
Beautiful. Yeah, it's definitely on our radar, and the M&A consolidation seems like it's picking up a bit of steam. So we are covering it and seeing how that all plays out.
Yeah, and if anyone knows of a good ASX listed copper exposure with assets in Australia,
the Metals Acquisition Corp is set to list, and it was interesting to see Capstone listed their CDI here this beginning of this week, I think, as well. So a sector that's pretty deprived here in Australia.
Yeah, absolutely. So let's hope that there are a few more copper assets that can come hit the local exchange.
Yeah, absolutely. Yeah. Beautiful. Well, really appreciate it. And for any of the money miners interested, I'd sort of encourage them to go and look at your Substack to get up to speed with your writing. But thanks again for making the time and coming on Money of Mine, Emmanuel.
No worries. Thanks, JD.
Righto, good stuff, JD. Love your bloody work, mate.
Oh, it's good to get the fundies on and pick their brains. Everyone's got a bit of a different take on the market, a different style. And in the volatility that we're seeing lately, it's good to hear what they've got to say, right?
Mate, full compliments from both of us as well. 2 interviews. you didn't fuck up one bit of audio or one camera on either of them. You have come so far. Well done,
Things
mate.
have come a long way.
That was bloody great, mate. I'm glad, and the old Melbourne trips are great. Getting access to these fellas as well.
Absolutely. There's
it's
more
good
coming.
fun.
More on the way.
Yeah. Who is on the way? You got any preludes?
We'll keep it quiet for now.
The suspense, mate. The global big dogs that are the biggest, most in-demand people for podcasts are coming to us now. And we might deliver him next week or two. Just letting everyone know who's the big dog in town.
There's a bit of a prelude.
Right, thanks to all the partners, SMEC and Anytime at the top of the show. Anything electrical, anything exploration, get SMEC and or Anytime Exploration. Also got DSI Underground, MMTS, KCA, K-Drill.
VRIFY and InvestorHub.
Oh, brilliant. Absolutely brilliant mob of people. And
Brooks Airways and Brooks everything else.
that was good.
Hooteroo.
Oh, JD, come back.
Just Trav.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.